Webinar on Bollinger Bands, brought to you today by Alvexo, a real broker for real traders. With Alvexo, you can trade stocks, indices, Forex, commodities, and cryptocurrencies. Now, if you want, during our class today, you can go to www.alvexo.com and open up a free demo account and follow along using the advanced charts on Alvexo and learn how to put Bollinger Bands on those charts. When you use Alvexo, you're able to trade on one of the world's leading online trading platforms, our web browser, which has been developed and designed, and the technology has been developed just for Alvexo. It's quite unique. It's easy to see. It's easy on the eyes. Everything you need is right in front of you. You have built-in trading signals. You have tailored reporting. You can set it up. It's personalized and customizable. And of course, it's user-friendly. But you can also trade with the Mt4 platforms. You can use the Mt4 web browser. You can use the Mt4 mobile device, or download the Mt4 professional terminal. You can trade across all of your devices seamlessly. And you can trade around the world using any platforms you wish, and you can intermix and change back and forth as long as you have your account with Alvexo. With Alvexo, you have access to over 450 real-time quotes. You can trade Forex, indices, commodities, shares, and cryptocurrencies. And as you can see on the screen, everything on the platform is easy to see. Everything is easy on the eyes, and everything is easy for you to understand. And that's because with Alvexo, you get cutting-edge technology, you get award-winning customer service, and you get a regulated provider. Now, today's class is being recorded. If you wish to see a recorded version of today's class, you can do so in about 24 hours by using the same link used to attend this class. Now, because Alvexo is a regulated provider, I do have to give you a risk warning. So I'm going to read the first sentence on each of the following pages, and I would appreciate it if you could read along with me. Contracts for difference are complex financial instruments and come with a high risk of losing money rapidly due to leverage, and is therefore not appropriate for all investors. This webinar is considered a marketing communication and does not contain and should not be construed as containing investment advice or an investment recommendation. Now, in today's class, we're going to be using some live charts, which are my teaching charts, and we're going to be specifically looking at the Euro-US dollar. That is the asset and the platform and the charts that I teach all my classes on. So we're not here today recommending that you trade the euro. We're not giving you any advice on where the euro is going to go. We're just using my standard live charts. Now, in today's webinar, I'm going to provide you a lot of my personal opinions and experiences. And believe me, I don't know which I have more, experience or opinions, because I have opinions on everything. I'm going to provide you information that's generally available to the public. Believe me, there is no secret sauce, no secret weapon. Trading is about experience, knowledge, strategies, and risk management. And then I'm going to back up. Trading is about risk management, knowledge, experience, and your strategy. Never ever trade somebody else's recommendation. You can use their recommendation as a bit of a starting point, but never trade what you don't understand. And I'm going to go back to the most important one, risk management. Now, also in today's class, I'm going to use the term security, but I might say the Euro-US dollar, which I know I will. I might say bonds. I might say Facebook. I might say Google. I might say Bitcoin. But I'm not talking about any specific asset. I'm talking about all publicly traded financial instruments in which an open market exists. It just gets very, very boring saying the same thing over and over again. Similarly, I intermix the terms investing and trading. Fact is, most investors could care less about technical analysis because it doesn't apply for them over a long term. We're talking today, and most of us here are traders. And we know the difference between trading and investing. Trading takes a much shorter position, and most traders could care less about the inside workings of an asset because we're never going to take delivery. We're never taking ownership. We're only concerned with price movements up or down. I don't care whether Google's a sound company and Google's going to make a fortune over the next 10 years. I only care that Google's going to go up over the next 2 hours or the next 3 days and allow me to make some profit. That's why I'm a trader, you're a trader. So let's start discussing Bollinger Bands. Now, Bollinger Bands is a pretty unique technical indicator. Now, technical indicators are only a small field of technical analysis. But what makes Bollinger Bands very interesting is they were created by money manager John Bollinger, hence the name Bollinger Bands. And it's rare today to see a chart that doesn't have Bollinger Bands automatically ready to be dropped on. But John Bollinger is still active and alive and involved in the markets. And he operates his Bollinger Band website. So there's lots of indicators out there that we get all kinds of discretionary stuff about. We get gurus telling you what to do. In Bollinger Bands, you can actually go back to the horse's mouth and understand exactly how he developed it, why he developed, and read about and watch his videos and everything else, or listen to his lectures so that you understand specifically about it. Because there's an abundance of information published on how to trade with Bollinger Bands. Much of it, though, is discretionary in theory. Because we have Bollinger Bands, but then some John Doe is going to tell you, okay, when Bollinger Bands breaks above the moving average and you have this, and that pattern, do this, this, and this. That's his discretionary theory. It's not what Bollinger says. But we can use it many ways. The how to use Bollinger Bands information usually pushes it back to the trader to interpret what the securities price is doing relevant to the bands. Now, Bollinger Bands is one of the most popular indicators in the Forex market, as well as CFD trading and cryptocurrency. The reason being is Bollinger Bands can be applied in all financial markets because Bollinger Bands can be used in any time frame, from very short periods to hourly, weekly, up to monthly. Now, Bollinger Bands answers one specific question. Are prices high or low on a relative value basis? Because if you're looking at an asset and we're looking at euro US dollar and whatever it's trading at, say it's trading at 122. Is it high on a relative basis, or is it near the bottom at a relative basis? If it's high on a relative basis, well, maybe we don't want to get into it at this price going long. We want to wait till it's more closer to a low. So by definition, price is high at the upper band and price is low at the other band. And that's a valuable piece of information. Okay. Now, a lot of you may not have used Bollinger Bands and don't know what it looks like on a chart. I'm going to take you to a chart in a second. Bollinger Bands are a technical analysis tool. Specifically, they are a type of trading band or envelope. Trading bands and envelopes serve the same purpose. They provide relative definition of high and low. So Bollinger Bands consists of a middle band, which is a moving average, and an upper and a lower band. These upper and lower bands are set at what's called standard deviation. In the standard cases, 2 standard deviations. So let's go over to a live chart and let's see what this actually looks like on a chart. Okay, so as I mentioned, Bollinger Bands is a very popular indicator. So we just go up to indicators, click on our Bollinger Bands, and whammo, it's dropped on our charts. Now I'm going to change a couple settings only to make it easier for you to see. So I'm going to make, all I'm doing is visual stuff at the moment. I'm making the center line and the upper and the lower lines broader, bolder, so you can see them better. Okay, so what we have is this squiggly mess on our charts, and we have this upper band and the lower band. And then we have this grayed in area. The grayed in area doesn't really tell us much. The shape that the Bollinger Band is making doesn't tell us much. Okay, I've seen them look like aliens. I've seen them look like fish. I've seen them look like dragons. There's no rhyme or reason about what they look. Now, the width of the bands can help us judge the volatility of the markets. The wider the bands, the more volatile the market. The more constrict the bands, the more congested or the less volatility in the markets. Okay. That's the only thing that we can tell with these width of the bands. Everything else is based on the relationship of price with the lower band and the upper band and the center band. Okay. What it's doing in this area is really unimportant to us. So we start out with our Bollinger Bands using a 20-period moving average. And it's just a moving average. We have it now here in a red line. Okay. From here, we're going to put two other bands on our charts. Okay, this is the upper and the lower band of the Bollinger Band and is based on a statistical mathematical formula called standard deviation. Now, I'm going to explain to you today what standard deviation is. It's a little bit boring. It's a little bit, not confusing, but it's a little bit mathematical. So believe me, it took me a long time to figure it out. But you have to understand the general principle, because it's the only way you're ever going to be able to tell whether you're getting solid signals, bad signals, false signals from the Bollinger Bands, and when those signals are not being accurate or what type of market they won't be accurate in. So let's go back and talk about these funny things called standard deviations. And then we'll go on to using these, but you have to understand what makes up an indicator so that you understand how or when it's working correctly or not. So Bollinger Bands are typically charted over a 20-period time frame. Okay, so we start out now. If you're using a 20-day, it's 20 days. If you're using a 21-hour chart, it's 21 hours. If you're using a 15-minute chart, it's the last 20 15-minute periods. So interesting, in the real world, no statistician would ever calculate standard deviation by hand. The calculations involved are somewhat complex, and the risk of making a mistake is high. So believe me, you'll never have to do a calculation, and I'm not going to calculate it today either. Now, I'm going to give you the mathematical definition of standard deviation, and then I'm going to go back and explain it in words you and I understand. Standard deviation is a measure of a dispersion of a set of data from its mean. It is calculated as the square root of variance by determining the variation between each data point relative to the mean. If the data points are further from the mean, there is a higher deviation within that set. Well, I'm sure that didn't mean anything to anybody, unless you're a mathematician. Didn't mean anything to me the first 20 times I read it over the years, but I slowly figured it out. So let's change some of the words. Standard deviation is the measure of the dispersion, the measure of the difference of a set of data. What set of data do we have to use when we're looking at the financial markets? It's how far apart the open, the high, the low, and the close are. And what's another word for mean? From its moving average. So standard deviation is a measure of the separation of the open, the high, the low, and the close from its moving average. It is calculated as the square root of variance by determining the variation between each data point. So what are each data point? We're figuring out the variation between the open and the high, the open and the low, the open and the close and the open, and then coming up with the difference between that and the moving average of the last 20 periods. If the data points are further away from the moving average, there is a higher deviation within that set of data. Now, don't you think it's important to know between the open price and the close price? You know, they're kind of important, but how high that high was relative to the open and how low that low was relative to the open. Okay, and then in between them, where was that close? All of that's important because the market is very volatile and the high is all the way up here and the low is all the way down there, but the open to close ended up virtually where they started. That's telling us because there's something different between that time period and if just the open and the close were the same distance, but there was very little upper movement or low movement. So it's very important that what this data is that is analyzing is quite critical. So in its simplest form, the mean is simply the average of all data points in a given set. In investing, for example, you might want to know the mean closing price for the last 20 days. That's the moving average for the last 20 days. This can be obtained by adding the closing prices of each session and dividing by 20. Now, the mean, this means the calculation is always taking into account the most recent session's movement. The older sessions drop off as they become less relevant. Now, an exponential moving average is calculated by weighting that data and giving more significance to that point. And the moving average line that we're using in the Bollinger Bands today is a EMA. An EMA simply gives more value to the most recent close and less value to the oldest close. So it weights that, which is more important because if gold was trading at 1250, 1250, 1250 and went up to 1260, 1260, 1260, and you took the average of the 20 periods, and most of those periods are 1250, but the last 3 periods are in the last little while was at 1260. The moving average of the moving average of that would just be at 1251. But see, a weighted moving average would probably be up at 1253 or 1254 because it gives more weight to that more recent change. Now, remember, Bollinger Bands contract during sideways markets. They are way above or way wide when they're volatile markets. And what's important is the relationship between the band and the prices. Okay. So we're only concerned with the upper band, the lower band, and the moving average. So we have the baseline, which is our moving average in the center. We have the upper band and the lower band. So let's go back to our chart and drop these on there. So I'm going to turn off this moving average. And now I'm just going to, because I just showed that as an example, but now I'm putting the Bollinger Bands back on there like we did right here. I'm going to get rid of MACD below because I don't need another indicator clogging up my screen. So the first thing that we're concerned with is the relationship between price and the upper or the lower band. If price is moving up, it should be riding what we call riding the bands, mimicking and moving along that upper band. When that movement starts to dissipate or slow down, doesn't mean it's reversing. We'll see the price move in between those bands and not being able to touch. When price moves up and breaks the band or gets rejected by the upper band, it's telling us the trend is in trouble. But we only make our decisions, okay, when price breaks the moving average. Say, for instance, here, we were riding the band down. This is a beautiful downtrend right here. Not much, volatility, but it was a nice move down in price, and we're riding the band. See how price is riding on that band? Okay, now we got a green candle, and the price was rejected by that lower band. It doesn't tell us much. This band here, which broke the moving average, then tells us that downtrend is over and price started moving in the upward trend. But as soon as it did, it broke the bands and then got rejected and fell below the band. Okay. And as long as it was above the moving average, we were fine. When it broke the moving average, now it tells us we reversed into a downtrend. See, a lot of times you'll get all of this, but it won't ever break the moving average. And then it'll move back down along the bands. So your trend slowed down, but it didn't reverse. Now, here we have a whole bunch of hogwash because we see price, it keeps trying to reach that upper band and push it up, but it keeps getting rejected. Price pushes up, rejects, push up, rejects, push up. But as long as it was staying above the moving average, it wasn't reversing into a downtrend. So it was just a bunch of congestion moving sideways. But with Bollinger Bands, the moving average center line, the baseline, is the critical point that's telling you whether that trend is in trouble. Well, when it gets rejected, it's in trouble. But whether it's going to regain itself and move back up, until it breaks the band, we can't make any final decision. Until it breaks the middle moving average, we can't make any final decision. So we're always looking at the relationship of the price to the upper or the lower band and its relationship to the moving average. So lower band, upper band, and middle band. Now, with Bollinger Bands, we have three types of uses. We get pattern recognition. Now, for our type of trading, pattern recognition is really a big waste of time. Bollinger Bands forms what's called the M's and the W's. They take a very, very, very long time to develop, like trying to trade a head and shoulders pattern. You don't see it till the last end of its developing, but it's not moving fast enough or ending or developing fast enough for you to actually do our type of trading. So again, it's like trying to use a head and shoulders. Once you've seen the head and shoulders form and it's formed the right shoulder and it's bounced off and it's gone through the neckline, well, it's telling you something about the markets. So, and it often makes what we call double bottoms. Price will come down, move back up, not break the moving average, and come back down and form another bottom. But again, it's very hard for us to see. Here's your W format. See, price moves down, forms a bottom, bounces off, forms the center of the W, but you have no idea W is forming, makes a second bottom. At this point, when it bounces off of there, you might see that a W is forming. But again, until it breaks that moving average, you can't make a trading decision. And look at all the candles it took. So for a long-term decisions or long-term environmental understanding, it's worthwhile. But for our type of trading, it really doesn't. So we have the M and the W. It just depends on whether we're coming off of an uptrend or a downtrend. Now, Bollinger Bands work extremely well when combined with other technical indicators, especially RSI. Now, the most thing about the bands, walking the bands or riding the bands, is a very important understanding. When price is moving either up or down and price is riding or walking the bands, well, we know that that trend is sustained. Bollinger Bands can also indicate the end of strong trends. Strong trends cause an expansion in volatility that will cause the bands to initially move apart, meaning the lower band will actually move down opposite the trend. When a trend begins to wane, the lower band in the uptrend will turn back up, which may be a signal that the move might be over, at least for a while. Volatility tends to be mean reverting. Periods of low volatility are generally followed by high volatility and vice versa. And then there's a very popular way that we trade Bollinger Bands, and that's called the squeeze. Okay, it's not very complex, it's not very market savvy, but it's quite reliable. When we see a period that the market has moved into contraction and the bands get very narrow, we know sooner or later we're going to get volatility coming back into the market. When we see a jump in the bands above or below the moving average and the bands begin to widen and price starting to move to that band, okay, we can then play the squeeze because we waited for the price to come out. We've now got the breakout and we can trade in the direction of that breakout. Now, while Bollinger Bands are exceptionally helpful in determining when an asset is overshot to the upside and the downside, it is important to use the bands to also set risk conditions, not just entry points. Now, we can use the bands and say above and below the, the band of the breakout time or the band, we can use that to set our stop loss and our take profit points. Now, there are just a few things you need to pay attention to when coming to using Bollinger Bands. During strong trends, price stays close to the outer band. If price pulls away from the outer band as a trend continues, it shows fading momentum. Repeated pushes into the outer band that don't actually reach the band show a lack of power. A break of the moving average is often the signal that a trend is ending. So I'm going to share with you a little presentation that's going to show you how to use Bollinger Bands and combine it with other indicators and build a strategy and actually use Bollinger Bands in your trading. And then I'm going to share with you an easy strategy that you can start using right away with Bollinger Bands.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market and may use it as a signal to exit a trade. Indicator 3, Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of their time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4. Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5. Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. We can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the Super Trend Indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the Super Trend Indicator to change red here before taking the short trade. So now we have the confluence of 4 indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the Super Trend turning back to red.
So as you can see, Bollinger Bands can be useful by themselves, but remember that they can be combined with other indicators. Since they are a pure price indicator, you might want to consider combining them with volume indicators for even more depth and insight. Ultimately, there's no indicator that guarantees you'll always get into the bottom or the tops. However, Bollinger Bands, especially when paired with other indicators, such as chart pattern recognition, can help you make better trading decisions. But remember, successful day trading is mostly a game of pennies. The best firms and individual traders who day trade look to make small amounts quite often with low risk. There is a preciseness here using Bollinger Bands in this way. You can use this preciseness to take your advantage. So I'm going to share with you a little presentation on a Bollinger Band technique that you could use quickly. And there's no sound to it. It's all in text and watching it. And it's just very easy, but when I did the PowerPoint, I just wrote the text across the bottom. So it's just a simple technique that you can incorporate into your trading. And what you do is you find the currency that's either in an uptrend or a downtrend. The currency must fall back from the uptrend and touch or almost touches the bottom trend of the Bollinger Band. Then 3, once the price hits the lower Bollinger Band, look at the RSI indicator, and it should be between 30 and 50 and be rising. After price hits the lower Bollinger Band and RSI is going upwards, then you want to make your entry, and you want to use your Bollinger Bands to set your stop loss and your take profits. So thank you very much for joining us today. If you want to learn more about using Bollinger Bands, go to www.alvexo.com, or you can go visit John Bollinger's site also. So remember, Bollinger Bands are an easy to use indicator that you can quickly add into your trading. So once again, thank you very much for joining us, and have a great trading day. Bye now.